Hello, everyone, and welcome to Live with Craig Couch. My name is Reagan Couch, and we are thrilled to continue this new broadcast series. Our goal is to provide useful and timely information on a variety of topics. Today's special guest is Matt Haggerty. He's the Regional Vice President with Lincoln Financial. We're thrilled to hear from him and get some updates on what the market is doing during these different times. Before we get started, a couple of housekeeping items. We are live, and we want to make sure that we get as many questions as possible answered. So be sure to use the Q&A box if you are on Zoom. If you're joining us through Facebook, then drop your questions in the comments, and we are monitoring those, so we will get those answered as well. If you're on Zoom and you submit them into the chat box, we may or may not see them. And I will go ahead and turn it over to Craig now.
Thanks, Reagan. Appreciate it. Welcome, everyone, again. And I'm really excited about today's topic. If there's one thing that I think has been on the top of everyone's mind ever since the COVID-19 coronavirus pandemic, give it a name, right? And fill in the blank. But ever since that started, we saw the stock market, we saw the markets just react really, really strongly in a negative way. Since that time, they bounced back. It's been all over the place. And that's probably one of the number one questions that is going through people's minds is what the heck and what do I do and how do I handle it? And so we brought the man on today who has all of the answers all of the time. Is that your official, unofficial title, Matt?
Mm-hmm. Yeah, you know it.
But yeah,
don't know that.
Who has the answer? So Matt, again, Matt, you and I worked together for a number of years, and love what you guys are doing at Lincoln Financial. Love what you're doing to just help clients, but also just to bring some calmness and some rational thinking. There's one of the teams, the firms that you work with, their tagline is they want to be the antidote to traditional thinking. And I love that. There's a lot of good lines. So I don't want to take a lot of time talking about this, but why don't you start us off by just telling us a little bit about your experience, what you do, and a little bit about Lincoln, just in a big picture. Then let's jump right into talking about what do people need to be thinking about and doing today.
That sounds good. Appreciate it, Craig. Well, I hope everyone is hanging on to their sanity the last couple of months and staying safe out there. So as Craig mentioned, my name is Matt Haggerty, Regional Vice President with Lincoln Financial. Been in the financial services industry for a little over 13 years now, and recently moved to Texas about 4 years ago. So I feel like I'm getting there. I'm almost a native Texan. I do have cowboy boots. I do own a gun, so I'm looking good so far.
Do you know how to say yeehaw?
I do. Yeehaw?
Okay. Yeah, you got it. That's
right.
close enough. You're good. Yeehaw.
Perfect. All right, we can work on that one. But yeah, at Lincoln, we've been trying to really, as Craig mentioned, try and kind of put out a lot of content revolving around how does this particular bear market that we're facing right now, because it is so unique and it is scary to so many people, not only from the fact that people are getting sick, losing lives, but also from the financial impact of it as well. And we want to try and put that in context with how does that look compared to other bear markets in years past? Because the reality is, things are different this time, but, things are often different. So we want to try and kind of give you guys some insight into how this one stacks up and what we might be seeing in the future months and years to come.
Well, Matt, I know that you and I were talking earlier this week, and, you had mentioned that, there's famous last words, right? That, for this bear market, this time it's different. And,
yes.
The reality is, I know you're going to talk about this, so I don't want to steal your thunder, but it's always different. I was watching I think it was a TV show a while back, and they were talking about something that might happen or might not happen. And one of the characters said, well, that would be unprecedented. To which the other person responded, they said, well, everything's unprecedented until it happens, right? I feel like that's the world we're living in right now. If we were to say, if 12 months ago, you or I or anybody were to try to have forecast or predicted what's going on right now, I think we would have got a lot of, hey, you need to get in a quiet place and calm down because you're talking just nonsense right now. And yet it's unprecedented. It's different this time. And that's what's happening. Reality is what has set in. True?
Yeah, absolutely. Yeah, I think as we talked about, Craig, and I love this line, is famous last words in our industry or when it comes to investing is this time is different. And what we're going to show here in a second is the reality is every bear market is different without exception. They all have their unique nuances, which you're going to see here in a minute. But the main theme is, okay, what does that look like post bear market? What's the recovery like? Because that's what everyone is waiting to hear the answer to. Granted, nobody has a crystal ball, but hopefully this will give some context.
Right. And I think everybody knows, but I do want to say it. I mean, nothing about what we're doing is trying to be predictive. We can't predict the markets. Nobody can. I tell people all the time, I tell clients, tell people that I'm working with, I say, if you're working with an advisor, a financial professional, and they tell you, here's what's going to happen in the markets over the next 6 months or 6 years, walk away. All right. Yeah. Because they don't know. If someone knew, we'd all follow that person. You know, one of the people that we work with, their prediction for 2019 was almost 100% accurate. But even that person, that economist will tell you, hey, we got it right this time, but we don't always get it right. You know, more times than not, we don't get those predictions right. So we've got to talk about not what is the market going to do, but what should we do? And I want to, with that being said, I know you've got some great slides. Let's jump into those, and let me let you talk away. Right.
All right. Sounds good. Okay. So hopefully you can see that on the screen. And so again, the kind of tagline of what we're going to talk about today is trying to build confidence in times of crisis. And I think the only way to have confidence, whether it's, playing basketball or playing golf or investing, is to try and have as much information as possible, to really kind of go back in history and see what worked, what didn't, and what does that possibly mean? No predictions, but what does that possibly mean for the future? So hopefully there we go. So on the next screen, I want to kind of give a little bit of context. Again, we just hit on this earlier. Every bear market is different without exception. I think you can see that on the left-hand side of this screen. Now, what this is listing is all of the downturns in the market that we've seen going back over the last 100 years. And it's delineating between, is it health-related, epidemic, or is it financial-related? Now, if you kind of remember some of these, obviously the ones in more recent times, the more severe ones have typically been more financially related bear markets. So this one is unique in that sense. I mean, I would say, even you can see listed here, we have measles, Zika, Ebola, cholera, swine flu. Those were not quite what we're seeing today. The response to the COVID-19 virus was way beyond anything that we've seen in our lifetimes. In fact, if you want to see the most recent example of that, you have to go all the way back to 1918, which was the Spanish flu. Yeah. Now, that one was very different. Just to give you some context there, that one killed worldwide. It's estimated from 50 to 100 million people. It had a death rate of about 10% of anyone that got sick, whereas currently on COVID, we're seeing it's closer to about 1%. In fact, if you, depending on your age, I have some stats, if you're 55 and younger, the statistical likelihood that you will die from this disease is 0.0022%.
Wow.
So pretty low. So that's 1 out of every 45,000. If you are 25 and younger, so for those of you that have kids and you're concerned, still stay concerned, still stay safe. But the positive note is the likelihood of them actually passing away from COVID is 0.00008, which is 1 out of every 1.25 million. So comparatively to the Spanish flu, drastically different, much less deadly. But in all fairness, the economy and people investing in the market was also drastically different in 1918.
Yeah, in 1918, absolutely.
Right. Most people on the call probably didn't, if this was 1918, they maybe didn't have the money to invest. They were just working on the farm or whatever. So it is a little bit of a different instance. So I think because of that, we have to look instead at the most recent crisis, which is probably 2008, and kind of do a little bit of compare and contrast there, because that's the one that's most fresh in everyone's memory. But before I hit on that, I do want to kind of make highlight of the right-hand side of your screen under the box that says Understanding Bear Markets. So we talked about this earlier. Every bear market is different without exception. You can see the reasons behind the bear market crash in each market event section. Every single one of them was different circumstances, different economic cycle, different time. with one
Yeah,
exception.
different in terms of, how far the market went down,
Yes.
And different in terms of how long it lasted, and definitely different in terms of, the how would it came back. Hey, quick question.
Yeah.
Bull market, bear market. How do you remember which one is which? Do you have like a little trick to remember bears are good, bulls are bad? I don't know. We eat bulls, we don't eat bears. I never can remember which one's bear and which one's
that's a good question. I'll have to think about that.
True confession.
Yeah. Bears, bears people, most people run from? Well, I guess probably run
I
from
think
a
I
bull.
would run from a bull as well.
Yeah, me too.
Probably so. I'm not sure. So anyway,
that's
go
a
ahead,
good
Matt.
point.
Sorry to interrupt you. Go ahead.
No, I like that. I'll have to come up with something clever on that. I'll need your help on that one. But so here's the one common theme with every bear market. You can see this is all the 25 bear markets that we've experienced in this country in the last 100 years. What is the one theme that is unequivocal and takes place every single time? It does recover. So that's the one common thread.
Yeah.
We don't know how bad it's going to be. We don't know when it's going to happen. We don't know the causing factors of it. But what do we know for a fact? It will recover inherently. Question is just when, right? And the good news too is you can see that the duration in months, which is important to note. Average bear market lasts 22 times. Average or 22 months. The average bull market lasts 55 months. So you're looking more than double the length of a bull market as opposed to a bear, which is why we invest in the first place, right? So now if we're kind of doing the comparison to 2008, and I think this is a great chart to look at on the bottom, is people could factor in, oh, we got this COVID situation unprecedented. We're in an election year. What's going to happen in November, depending on who gets in the administration? I would contend that it doesn't even really matter who's in office, what's happening in the economy, what's happening in the global scene. Is there a pandemic going on? Over time, we know that the market goes up, which is evidenced by this particular chart at the bottom. But that doesn't mean that people aren't going to be subject to some timing risk, right? It all depends on when they invest. Are they investing at a bad time, a good time? And we'll talk about that in a second. But I do want to do a quick comparison back to 2008 because that's the one that we remember the most recently. And I want to make it very, very clear. 2008 and what we are seeing today in 2020 are drastically different situations. As you saw on the previous page, 2008 was caused by financial the system. This is simply caused by a pandemic that was unforeseen and, not making light of people getting sick and passing away by any means. I don't want to minimize that at all. But a lot of what we're seeing right now, the economic impact of this is fear, right? This is the first pandemic that's had Twitter, that's had social media. So the information dissemination is so much faster that we can see it. And although statistically the likelihood of actually becoming terminally ill from this disease are low, it still is top of mind. And I think that creates a lot of fear, which is causing even more problems.
It's not just the dissemination of information, it's the dissemination of misinformation as well. And I'm not talking about, any kind of the news media, put that to the side, but there's no check when anybody wants to post on Twitter a picture or something that happened, and it's just not true. It's just not true. And maybe some people are doing it just to be, I'm not going to guess at their motivations, but sometimes we see something. I saw something earlier this morning and I said, oh my gosh. And I was immediately corrected, by someone that said, yeah, that's already been debunked. That's a fake picture. And I said, oh, okay, good. Never mind. I can move on now. But we deal with that all the time. And that's one of the reasons why I think what you said, fear is a huge factor in all of this as well, in the information that's out there. So
good point. And so, and I truly believe in, and this time will only tell, but I think 10 years from now, we'll look back on this and take a lot of lessons learned on the reaction to this crisis. I think quarantine in some aspect was probably necessary, but to the level that it went, I think that is going to be pretty debatable. I think it was really driven off of fear instead of data, but it makes sense. I mean, it was an unknown. It was something we haven't really dealt with in about 100 years since something that was even close to as severe as what we experienced back then. So again, 2008 and 2020 are drastically different. 2008 was systemically flaws in the system. This is just, we're dealing with the economic repercussions and the fear of what's been happening lately. And a couple stats I want to give you as well is The reason that 2008, as you saw on the previous page, it took, actually, I'll go back to that so everyone can see it. It took 17 months for everything to come back. So it was a fairly extended bull market in terms, or bear market in terms of how those go. So how is this one different? Well, first is the economy was extraordinarily strong prior to this happening, which is great news. I think, a lot of people thought the market was getting a little frothy. A lot of people are actually thinking that it was reasonably fair valued. So that's probably why we saw such a big correction, is they just were taking too much valuation out of it. And so I think that's why we've seen the market pop back up. It was an overreaction. But also back in 2008, one of the biggest issues was the Fed was pumping tons of money into the system. The problem was it actually wasn't making its way into the marketplace. It was just going to excess reserves of these companies. The good news now is the velocity of money actually from this government program is actually now hitting the marketplace. Now, again, I'm not a massive proponent of government bailouts. I think there's some inherent flaws there. But just to give you some kind of mind-blowing visuals is if you could take $1,000. So it's not like the movies where they have a suitcase, and they're giving a guy a payoff for $1 million and the suitcase is full. Let's pretend you could have $1,000 bill if those still existed. If you took $1,000 bill and stacked them, to get to $1 million, you would have a stack 4 inches high. That's it. Tiny.
Gotcha. Right.
If you were to have $1 billion, that stack would be 33 stories high.
33
if you were to have 33 stories of $1,000 bills would make $1 billion. $1 trillion would be a stack 63 miles high. The government just infused $6 trillion with this bailout package into the system. And the good news is a lot of it actually is hitting the marketplace via these PPP loans, which I believe you guys did a segment on or will be.
Yeah, we did those just sort of. Hey, say how I think you're cut out just a little bit. How big is this $1 trillion stack?
Yeah, it's 63 miles high.
Oh, okay. I missed that one. Yeah, you frozen up a little bit. So 63 miles. So
60.
Wow.
So that's a visual of how much $1 trillion is. And they're trying to flood the market with $6 trillion. Now,
good.
I think there's some issues inherent there because that creates more debt for future generations. But the reality is, will that make the recovery a little bit quicker? It's certainly possible. So there's a lot of factors that make what happened to 2008, I would say, extremely different than what we are seeing today. And hopefully, more than likely, less severe. And I guess time will tell. But here's kind of the main theme is, we don't really know. As Craig mentioned earlier, we're not in the business of making predictions. If we were, we should probably not be listening to this call. So by no means trying to do that. But what happens is, when we see situations like we've had, you're typically going to have 4 responses. You're going to have the opportunistic folks. For those of you on the call, you know who you are. You were the ones that were calling Craig up and saying, buy.
Yep.
I want to get in. Let's buy the dip. You had the steady folks who were probably just kind of a wait and see mentality. Let's ride it out. The uncertain folks that were maybe starting to kind of trickle some money into safer options. And then you got the apprehensive, or I would say the very conservative panic, quite honestly, and saying, go to cash, go to bonds, get me out 100%. So for those of you on the call, you probably know what category you fall under. And the bottom line is it doesn't really matter which area you fall under, because that's all just personal differences and where you are in your kind of life cycle of financial planning. But that's the beauty about working with an excellent financial planner like Craig, is he can kind of walk you through how to craft a portfolio that can help resist some of the downturns we've seen from this, still participate in the up, and still fit your model of philosophy and what you believe in from a financial standpoint. But regardless of what area you fall in, I think this is an extremely important chart to show. And this is what I would say is kind of the key takeaway from this entire presentation. Yes, we saw a dip. Yes, it is different than it was previously, but every bear market is different. What do we know with unequivocal 100% certainty? It always recovers. It's just a function of when. I love this chart. This is showing $10,000 being invested back in 1979. If you were to put $10,000 in the S&P 500 back in 1979, today it would be worth $867,000.
Mm-hmm.
That's a good return. That's that chart we showed, that kind of mountain chart that showed over the 100 years, regardless of what's going on, it trends upwards. However, here's the cautionary note. If you miss just the 10 best days of the market, you can see in that middle column, your return is about half what it would be if you stayed invested. Now that's 10 days over the course of over 14,000 days, and your return would be half.
Yeah, 14,000 trading days, and you chose, you're getting in and out of the market. You only were out 10 days, but you were out the 10 best days.
10 best days.
Yeah, I heard. Go ahead, Matt.
I was actually going to steal your line because we talked about it. It was I heard this from Craig, which is, there's no Hall of Fame for market timers. Everything else has a Hall of Fame. Market timers don't, because there wouldn't be one. It doesn't exist. It is literally impossible. The market just doesn't work that way where you can time it successfully. Maybe once, maybe twice, but not in perpetuity.
I think the two worst pieces of advice that I hear or have heard from clients that they received from other people when experiencing the market was, one was and you're talking about the different reactions that you can have, right? And one of them is, just like you said, you get really apprehensive. You say, oh, I'm scared I'm going to get out, and then I'm going to get back in when things are better, And the problem is, you don't know when to get out. You don't know when to get in. And that's why that approach, while staying invested, may not be the best path for you at that time. Certainly trying to time it is nobody's best path. According to statistically, it's no one's best path.
Yep, I agree. So the final takeaway of this is, yes, this time is different. But again, every bear market is going to be different. Are we through the woods yet? I think that's yet to be seen. Yes, the market has popped up quite a bit, probably because it was pricing in a bigger drop in earnings than it probably should have. Most likely that's the reason that it's popped back up. Are we going to see future economic fallout from this shutdown? I don't see how we cannot. So I don't think we're out of the woods by any means. But the bottom line is we have to find ways and strategies to make sure that you are keeping to your investment philosophy, your risk tolerance, your comfort level, but done in a way where you're not going to miss out on the best days of the market, but done in a way where you can also protect. And again, that's the main reason of why working with a financial advisor like Craig, one of the best in the business, can help you craft that portfolio. And there are financial solutions out there that can accomplish both of those, depending on your risk tolerance, can still give you that upside participation and can still hedge you on the downside should the market go down. And Craig can kind of put that together in a holistic portfolio for you to make sure that it's all weather and can be built for the long term.
Yeah, absolutely. And what do you want to speak specifically to? I think you made the comment, or I don't know, I've talked to so many people lately about, what am I getting? We talk about, bang for your buck, or, if I'm going to, buy something, or if I'm going to subscribe to, Hulu or Netflix or whatever. Okay, what am I getting for my, $10.99 a month? What am I getting for that? And I think with our investments, sometimes we have to ask that question. Okay, what am I getting? What's my potential risk reward when I'm doing this? And is there a way to get more bang for our buck without, giving up all, what I'm saying, without saying, well, if you want any return, you have to be really, really risky in the market. And is there a way to avoid that? I know we don't want to get into specifics talking about products, Matt. I'm going to ask you to do that. But can you talk specifically about strategies that we can employ in a general sense?
Yeah, absolutely. And I think that's the trick right now. And that's what makes this incredibly difficult to navigate this, bear market that we're in or we're in, is because traditionally, if you wanted to try to take risk off the table, what kind of instruments would you use? You'd use cash, fixed income, so like bonds. But of course, back then, those instruments were paying a lot better than they are now. So we're in that kind of awkward place where people are nervous about equities because they're seeing what's going on the news. They're maybe watching too much CNBC. But then the alternative to that is historically low interest rates. So again, it's a very difficult place to be in right now for that more moderate investor. So I think it depends on a couple things, Craig, is intestinal fortitude on how much risk you can take would be number one. And then two would be timeline, right? When does the client need this money? Are they young enough to be able to let it ride and not miss out on the 10 best days? So depending on those factors, short answer to your question is yes, there are solutions out there that can kind of hopefully, depending on the structure, give the client the most bang for the buck. For instance, it would be able to participate in the market in some cases with unlimited upside, but would have some hedges on the down. So would actually be able to protect their downside should the market drop again and we have a double dip. Again, solutions like this are not going to be the entire portfolio, but you can carve out chunks of the portfolio to use these type of instruments to help hedge yourself and keep you within your risk tolerance without having to go to fixed income and make it, a very, very small rate of return.
Yeah, because those traditional solutions are not necessarily, like you said, fixed income. So, you're talking about bonds, most people, that's our mindset, right? If I want to be safe, I'm going to move into bonds, but that's been not been the case, over, well, I don't know since how long, but I mean, it's been quite a while since, we thought, oh, we can just go to bonds and we'll be fine. That'll be safe. And then move back into stocks, later on. Has not been a solution. People have lost money in that part of the market as well.
Yep, absolutely.
And so, so I think that, the idea that, we can have the opportunity to, again, invest in the market, have the opportunity to experience some of that upside without, taking on all of the risk. And, what you're doing in any case when you're investing is, you're assuming some risk, but then if you can get someone to share that risk with you, right? If you can get someone to share that risk, then you are, then that's when you're able to, as we keep saying, get a little more bang for your buck. So,
yeah, absolutely.
And that's what, companies like Lincoln, and I know you guys are great. We're not here to, just, pat Lincoln and tout Lincoln on the back, but you guys are great in doing that, and how you can, provide, solutions which give people the opportunity to make a higher rate of return, but at the same time, Lincoln says, hey, we'll take on some of the risk. Here's what we're going to take back, right? I mean, there's always a price. Nothing is, foolproof, or, the old too good to be true. There's nothing like that. There's not. There's always going to be some kind of trade-off. You're going to have some of those trade-offs. But what I think I hear you saying, Matt, is that for the individual investor, they need to decide what is the best course for them.
Yeah, absolutely. Because there's always going to be trade-offs with every investment. That's a great point. So do the trade-offs, or do the rewards far outweigh the trade-offs? And do I have the time frame to be able to keep this investment for long enough to make it pay off? Do I have the stomach, quite honestly, to be able to to ride the market? Or do I need more protection and maybe have a little bit less return? But there is a solution for everyone. That's the good news. And it doesn't have to be bonds or cash or something with a very, very incredibly low interest rate. There is still good, rates of return to be had for any risk tolerance. And I think that's the bright spot right now.
Right. Can you go back a couple of slides? I think it's one or two. Yeah, go back to this one right here. Yeah, that's not that one, but your response, the very next one. Yep, there you go. Your response matters. So I wanted to look at this, and you said, because you were saying, hey, here's the general reactions. And so as the investor is sitting there looking at their portfolio or their situation, I think, I don't know that there's another, you laid these four out, and I don't know that there is another option on the table. And, you're either going to, like you say, you're going to go, okay, markets are down, it's time to buy, or you're going to say, hey, markets are down, but they'll come back, so I'm just going to ride it out, right? Stay this steady. And then you've got, people that are sitting on the sidelines and say, well, I'm going to wait till that's the uncertain. I'm just going to wait till the right time, to invest. And then you've got the people that you call it apprehensive. I think that's being nice. I think that's
yeah.
You're going to say apprehensive. No, we're going to say panic, right? And fortunately, and again, if you've got somebody that you can work with, and we got clients that are working with us, and our team is able to bring some a little more take away the overreaction, the catastrophizing, when everything's going wrong. But at the same time, everybody's situation is different. Okay.
Yes.
And so there's not one right answer. And I think that's what you guys are saying. There's not one right answer here. There's a lot of different solutions, and everybody just has to figure out and find out what's the right one for them. So, okay.
Yes, sir. You got it.
Matt, fantastic. What else have you got for us? Anything else? I mean, we could sit here and talk about this all day, but
I wish I knew some good jokes. I don't, unfortunately. Let's see.
No,
I've been being stuck in quarantine. I need some new material. I've got nothing right now.
You need some new material. Yeah. All right. Definitely need to work on some new joke material. Well, I've got some material for you. All right. So
okay.
With Craig, we don't let anybody get out of the room unless they're answering some questions. So are you up for a little game?
Yeah, let's do it.
All right. This is a game. It's called This or That. I'm going to name 2 items, and you got to pick one.
Okay.
All right. Now, Matt, I do want you to know ahead of time that these choices were not picked specifically for you. These were actually randomly selected by a supercomputer that is buried deep in a bunker somewhere in the state of Nevada. All right. And that's not a true statement.
Deep in the mind of Craig Couch.
Deep in that's a deep, dark place.
The bunker.
Right there. All right, here we go. This or that: Reese's peanut butter cup or Hershey's bar.
Oh, I got to go peanut butter cup.
Yeah, I think that's a clear winner right there. Sorry, Hershey's.
Yeah.
John Wayne or Clint Eastwood?
Yeah, Wayne was before my time. I got to go Eastwood on that.
Yeah, I was about to say, do you know who John Wayne is?
Of course. I'm actually 56. It's just vitamins, It's
I got you. That's right. So, Audi or BMW?
Ooh, Audi.
Thank you very much. Thank you. I like that answer. There are no right answers, but that was the right answer.
Okay, all right.
Foosball or ping pong?
Ping pong. Oh, I like both. Oh, man, ping pong. Ping pong.
Yeah, my high school, we had a foosball table in the lunchroom.
Oh, sweet.
Every day, all the time when I was in high school. Lots of fun. Boston or Miami?
I've never been to Boston.
Really?
No. So it's hard for me to say, but I have to go Miami. I've never been to Boston, I suppose. I can't make an informed decision.
You should make. Well, no, it's your decision. Boston's incredible, by the way. So
yeah, that's what I've heard.
It's really great. You ever get the chance to go up there, go up and walk the Freedom Trail? I did that last year. I think I've done it, but it's absolutely amazing. So it's a good time. So that's it. That's all the questions for you, Matt.
All right.
Really appreciate it. Really appreciate the time today. Up and down. It's a different world that we're in right now. Obviously, not just with the markets that we're talking about, but it's different in terms of how we're working and how we're interacting. I'm really, you probably have been as well, but I've been really amazed at so many positive things that have come out of this. Obviously, it's been a tragic time in terms of the illness and the death, and we're aware of that in terms of the impact on businesses. But when you look around, there are so many people who have taken this opportunity to do good and to be good and be the kind of people that we know we can be and that we want to be, to help one another and to be there and care for one another. So that's kind of the Craig Couch positivity of the day for what we're looking at right here.
I wish that was the stuff on the news feeds instead of the other stuff. I guess it doesn't get clicks apparently. So
it doesn't. Well, it gets some, and I don't know if you've seen John Krasinski, started this Some Good News.
Yeah.
And if you haven't watched any of those, I mean, go look at some of those. They're fantastic. And grab you a box of tissues. All right.
Okay.
You're definitely gonna cry a little bit. And so apparently he's going to keep that thing going in some form, even after the pandemic. But he said, hey, there's all this bad news. We got to get some good news out there. Just telling a lot of good stories and really highlighting and showing, the positive that people are doing. So, anyway, thanks again, Matt. Thanks, Reagan and Megan and everybody who's was able to join us, live either on Zoom or Facebook. We do want you to know that if you have questions, you need things, give us a call or call whoever you're working with. Get some good information because there's a lot of it out there. Make some informed decisions that are going to be right for you. And again, we appreciate the time. Thanks a bunch. And Matt, we'll see you real soon.
That sounds good. Thanks, Craig.
All right. Take care. Bye-bye.